Hey everyone, it's Spencer Hakimian and welcome back to yet another episode of What's Moving Your Money on Forbes. On today's episode, we have a lot of things to cover. We're in the thick of earnings season now, and we are starting to get some early signs that tariffs are materially impacting companies. This is no longer theoretical. We are getting major, massive, blue chip, household American company names that are telling us we are literally being impacted by tariffs. So as we dive into it, we're going to focus on two companies. One is going to be GM, General Motors, and the other is going to be Cleveland-Cliffs, which is the biggest steel maker in the United States. So everyone sit back tight, get ready, and I hope you enjoy another show. So GM reported earnings this morning, and to say the least, they weren't pretty. Not one bit. There's not really much to sugarcoat about this. There was very few positives to take out of this entire report. Particularly, GM had noted that their earnings, their net income, had fallen by 35% versus this quarter last year. 35%. That's a massive fall. Now, what was behind this significant drop in their earnings? Well, they said it explicitly. They had to do a $1.1 billion charge-off as it related to tariffs and the cost of decreased production both in the United States, Canada, and in Mexico. And it was related to all of those charges where they saw their free cash flow drop by, again, $1 billion. Now, this is particularly significant because GM is projected to only earn $8 billion of free cash flow in fiscal year 2025. Now, if they're losing $1 billion extra per quarter versus what we were expecting at the beginning of the year due to all of these tariffs, then you can expect $4 billion to come off their entire year's, bottom line due to all of these tariffs. If $4 billion of their $8 billion of profit gets wiped out, that's half the year's profit gets wiped out. The stock will have to trade down. You have to remember that all the stock market is, at the end of the day, is a reflection of the future earning power of a company. That's all it is. Stocks move based on what was priced in to happen versus what was expected to happen. And we're validated. Today, market pricing validated everything that we thought. GM was down 8% today. That was the biggest fall it had taken since April, and before that since February. Now, GM is particularly notable as it relates to tariffs because there are so many ways that GM was impacted by all of the previous and, to be frank, ongoing tariff drama that we've experienced. GM is obviously exposed to auto tariffs. They're obviously also exposed to steel and aluminum tariffs. GM is also exposed to tariffs on Canada, Mexico, and South Korea. They have a lot of production happening in those areas. On top of that, GM also has a pretty significant electric vehicle line. All of the battery tariffs affects GM. So it's one of the companies that was most significantly impacted by the totality of the tariff program. Remember, I always say it. It's not one tariff that's particularly problematic. It's the compilation. It's the assortment of all of these tariffs stacked on top of one another. That is where the problems happen. And unfortunately, we're seeing it. My big concern is that GM, the auto industry in general, has one of the deepest supply chains on earth. To make a car requires, in some cases, 200, 300, 400 different vendors. Someone does the wheels, someone does the brakes, someone does the glass, someone does the leather, someone does the electronics, someone does the engine, someone does the pistons. There are so many different vendors that go in. If you start getting layoffs in the auto industry, that historically tends to cascade through the entire economy. Most people at this point have forgotten, but one of the main causes of the 2008 financial crisis was the auto crisis. It was so deep and so extensive that so many different parts of the economy got impacted by it. So we covered autos. Next, let's go on to something that's really been troubling me, and I'm pretty alarmed by it. And frankly, I don't want to pat myself on the back, but this was something I've been sounding the alarm on for months. It was obvious then, it's materializing, and it's obvious now. Cleveland-Cliffs, which is the biggest steel maker in the United States, just announced that they are raising their prices 15%. They announced that they already picked up their prices just from the previous quarter, double digits. Now, why do you think that is? Well, when we place a 25% tariff on all foreign steel that's coming into the United States, guess what the domestic steel makers do? They take advantage of that. It's just simple supply and demand. There's less supply coming into the United States. There's a 25% penalty if you want to import steel from Brazil, as an example, into the US. So the domestic manufacturers say, hey, look at this freebie we got from the US government. Let's raise our prices 15%. We'll still be 10% cheaper than our competitors, or our previous competitors, I should say. So this is not real growth, right? This is not real prosperity. This is pure textbook inflation. There is no benefit to having this company just be allowed to raise their prices by 15%. As a matter of fact, in the long run, this makes Cleveland-Cliffs less competitive in the global world. Hey, they got a 15% advantage in the United States. They're not going to bother selling it in France or in Argentina or in South Africa. And if they do try it, and guess what? In those countries, they're not going to have the advantage of tariffs, right? That protection that our tariffs are giving them. They become less competitive. This is literally one of the most clear and definitive lessons of the history of tariffs. The companies that you toddler, the companies that you put on, training wheels, on a tricycle, they become babies, right? They can no longer compete with the rest of the world. And a recurring theme of this podcast, I've always said it, is this is a competitive world. We are no longer just competing with whoever's in our backyard. Let's use me as an example. I, Spencer Hakimian, I do not, as a hedge fund manager, just compete with the 40 and 50 other hedge fund managers on the Upper East Side in New York City. I'm competing against the hedge fund manager in Paris. He's competing with the hedge fund manager in Dublin. That lady is competing with the hedge fund manager in Singapore. That guy is competing with the private equity firm in the United Arab Emirates. We are all competing against one another in the era of the internet, in the era of transparent prices, in the era of high information. You have to compete more. It is just the reality of what it is. And by putting tricycles, by putting training wheels on our own companies, in the long run, we're actually most likely going to hurt all of them. Now, this was a very busy week in markets, but it pales in comparison to how busy next week is going to be for markets. We have a Federal Reserve meeting. All of the drama that's going to involve Powell and whether he's going to get fired or whether he's going to voluntarily step down or whether he's going to get criminally investigated for that renovation that we spoke about in the podcast earlier this week, that's all going to come to light. Beyond that, we are rapidly approaching the August 1st deadline for tariffs again. And frankly, if President Trump does not go through with the tariffs at this point on August 1st, I struggle to see how he's going to maintain any credibility with not just the market, but with our trading partners, with our allies and our adversaries alike. If every single time he sets a deadline and then he just blows past it and extends it, no one's going to come forward and negotiate with him. Tragically, I think we're already seeing it. We really aren't seeing any substantial trade deal. The biggest trade deal that we've announced in the past 6 weeks was maybe today with the Philippines. We announced we are lowering their tariff rate from 20% to 19%. We do about $10 billion a year worth of trade with them. So a 1% difference is we're talking about $100 million. I mean, we're talking about peanuts in a $30 trillion economy. So again, the warning signs are there. I don't want to sound too pessimistic, but if we have another taco situation, I don't know how he maintains credibility much longer beyond that. So these are all the things that we're going to be looking forward to in the week ahead. I'm going to ask you guys, if there's any specific episode or topic or idea that you want me to cover, always feel free to comment it on our website. You can comment it on Forbes' YouTube page. You can comment it on my Twitter page. on my TikTok or my Instagram page. It's on Forbes' website, on Spotify, on Apple Podcasts, wherever you might get this. I read all the comments and I respond to all the comments. So if there's a specific episode that you want for next week or in August, as we get into the dog days of the summer, that really slow lull in August, please let me know and I'd be very glad to make a podcast about it. So I hope you guys enjoy and I'll talk to you guys soon.